Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Have you been wondering if you started your real estate investing journey at the right spot? Or are you wondering where you should start your journey? In our conversation today with my guest, Denis Shapiro, we're going to talk about finding real estate success by building real connections, and it goes all the way back to how he started other businesses and how he figured out the right way to build his real estate success, and it's all based on people. Let's go. This is episode 135 of Zen and the Art of Real Estate Investing with my guest, Denis Shapiro. Denis started investing in real estate in 2012, created a diversified portfolio of ATM funds, mobile home parks, life insurance policies, tech startups, industrial property, several other things. He leveraged those into a lot of success, ended up launching SIH Capital Group, which he is the managing partner of. He also has a book, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways. Denis, welcome to the show.
Jonathan, thank you so much for getting that done and having me on. I really appreciate being here.
Yeah, no, me too. I'm excited to talk to you about your experience and the diversified assets that you've invested in. But when you were younger growing up, when was the first time that you remember being interested in real estate?
So the first time I was around 14, my oldest brother gave me a copy of Rich Dad, Poor Dad. The funny story is I hated the book.
14 is pretty young for it.
Yeah, I didn't have the right mindset for it. But I also thought he was like a hypocrite where I thought he was probably making more money on his like book tours. And
that's fair. That's smart though.
Yeah. So I took it with a grain of salt. 10 years later, I revisited the book and had a very, very different viewpoint. And it actually, that book, I not Rich Dad Poor Dad, but Cash Flow Quadrants, when I was leaving my W-2 was incredibly influential. Like reading it like for the fourth time, I don't know why, just cemented me actually leaving my W-2 at that point. So the first time was at 14. My brother gave me a copy of Rich Dad Poor Dad. I did take away from that book that I should start investing into something. Yeah. I started with stocks, bonds. At that time, it was actually like mutual funds were all the rage. And then I kind of went the whole route where I wanted to be like the next Warren Buffett, went to business school, got my MBA, still kind of in the financial crisis, started working for the government. And then when I got my first paycheck, I realized that they were not only my employer, they were also my business partner with the amount of taxes they were taking out.
I had the exact same experience.
And then, because, when I was working my high school, college days, you don't really pay a lot of taxes as, someone who's making $6-10 grand a year.
Right. It's also exciting because you're getting money. It's just like free money.
But when you get that first real paycheck after your salary and all of a sudden you're like, whoa, that's a lot of going to deductions. Yeah. So that's when I kind of got into the whole real estate rabbit hole, the whole bigger pockets thing. And then I did it the wrong way for a really long time. And then the last couple of years has been a very different story. But yeah, so 14 was stocks. And then at 22, when I got my first job, that was when I really got into real estate.
Yeah, I very similar for me. My dad got me started with stocks at about 14, 15, let me play around a little. I gave me a Merrill Lynch advisor and I started to figure out and did well in it. But we were involved in real estate, so I started to see it at an early age. What do you think? Why was the difference in timing? Obviously, you were young at 14, but what was it about that timing? Was it leaving the W-2 and you pick back up the book and it hits? Because that's what most people say. They've got it before, it sat on a shelf, and then they read it at the right time, and they're like, whoa, this is way different than I remember.
Yeah, I think it's just all about reading it at the right time. It wasn't the right time at 14, especially I didn't have a W-2 to complain about. Right? So that's why when people are always like, oh, I'm just going to go work for myself. And when they're in college, I'm like, oh, okay, so what do you not like? Like you need motivation. You need something to understand why working for yourself is actually better. And if you don't go through the garbage time while working the W-2, it's like, how do you ever get that motivation and stuff like that?
Yeah.
Yeah. So I just think it was the right time, 10 years later. And then I reread it 20 years later. So I don't know why I read it like every decade.
Yeah.
And now that I have younger kids, I actually am blown away of how great the game is for the kids.
Cash flow. Yeah.
Everybody always tells me to do the kids version. Honestly, I did the adult version for them and they picked it up. They never did the kids version. And like my kids actually used, like my 8-year-old is saying the word asset.
Yeah.
And
That's awesome.
I'm like, this is amazing. I'm like I would have never been able to put something like this together. So I have a much more respect for him today than I did as a 14-year-old.
Yeah. I think you made a good point, though, about the game. I mean, really, cash flow is not harder than Monopoly, as a game for kids. So why dumb it down to the original version when you can have an 8-year-old going like, I don't know, that's not a great asset here.
Yeah. I'm like, well, the stock could go to 40 or could go to 0 and you're buying it at 40. What do you think? And they usually are pretty quick at like coming up with that. That's a bad, an investment decision. And just, it's so fun because so much of that game has like, oh, you're going to be acquiring a property. And then they're going with me to actually acquire properties.
Yeah.
And it's almost like they're getting to play real cash flow. And then I could walk them through the real numbers on it. And I'll be like, well, do you think this is a good deal or not a good deal? And without the game, I don't think that would be possible.
Yeah, and I think it's really important now because a lot of my kids are older, and I realized obviously in school, like they weren't teaching them about real estate or investing or money in general. But my dad taught me. I don't think I did as good a job as my dad. But are you seeing it though, even at this age, that it's really important to have this alternative asset point of view? Because maybe you still want to get a regular W-2 because that's good, steady income. But also you can do this on the side that can create future value later. Is that what you're trying to get across to them now?
Yeah, I think so. One of the main things I want to get to my kids at this age is that there's so many misconceptions out there in school where my son will come up to me and he'll say like, Dad, is 100 million a lot of money? Or like, if you have 100 million, does that make you rich? And I've been really working hard at saying, no, that doesn't make you rich, because if you don't know what to do with that money, you're going to go through it or whatever it is. There's plenty of lottery winners. I was trying to explain to him whatever it is. Yeah. So I try to explain to him being rich is the ability to make massive amounts of wealth. It is not having massive amounts, because you could, you take away all Elon Musk's money, next week he'll have another company and he'll go ahead and be a billionaire again, yeah. Right? He knows how to make wealth. So that's what I try to get across to my kids. And I think I want to be that contrarian, because 99% of people out there are kind of giving him misinformation. I just want to make sure when it comes to financial wealth and well-being, he's getting that information from me. And then whatever he decides to do with it is going to be his business later on in life.
Yeah, but at least he'll have a more open point of view on it and not think that you're just grinding it out to get to this mountaintop. And then you're like, well, now what do I do? I mean, this isn't that fun. I'm standing here by myself. Do you think that part of that point of view that you have and what you want to depart is also why you like a real diversified portfolio? Because I know we'll get into that. I've always been an advocate of that, including real estate. And I think real estate can be super diversified with a lot of assets that you've owned. But what's your attraction to that, keeping it so diversified and not all the eggs in one basket?
So the simple answer is that I've learned that assets have very specific characteristics. And when you try to impose characteristics, like if you try to impose cash flow into the stock asset, like it's bad news. Like I've invested in stocks since I was 14. I still invest in stocks. I have a collateralized account, which then I use to invest in real estate. But I've learned that stocks are incredible equity multipliers. If you don't touch them, if you don't sell into panics, whatever it is, it could be very passive. You're not talking to the CEO. You don't have to do much networking. You buy a good index fund, you leave it, and it will do its job, which is equity appreciation.
If you just leave it alone, though.
if you just leave it alone, right? If you don't panic, if you don't, go to barbecues and get financial advice from your uncle while grilling, it can be a great, great, wealth builder. And as long as you don't sell and you learn to collateralize it, it's somewhat tax friendly. Great. But now you look at the cash flow side of it, and it's terrible. A good index fund will pay you 1% to 2%. If you try to get dividend stocks, they usually underperform a good index fund. And then when the market is down, the algorithms bring those down as well. So what I've learned is by having a good equity portfolio, that will accomplish a lot of my appreciation. Now, when I get into the alternative sides, that's the side that, like, if it's like a pie chart, that's the side that I want a lot of cash flow from. And then, modest equity appreciation. And that's what I find alternative investments to be perfect in. So it's like the marriage of the two work really, really well. So it's because I'm really greedy. I want in my portfolio, I want cash flow and I want appreciation. Yeah. And the only way I figured out how to do it is by combining different asset classes and taking the strengths of one and complementing it with the strengths of the other.
Yeah, that makes a good point, because I think like your heavy cash flow assets in real estate often come with a whole bunch of other options that people don't expect. So new investors can say, "Ooh, that cash flow sounds great, but that's going to be on a D+ property with rough tenants and a lot of maintenance." So if you can balance out the cash flow, knowing what your management styles is with something that's more passive like a syndication, then those assets are going to balance each other. In terms of real estate, what was the first property type that you bought on your own?
Yeah, this one is great because it was such a bad deal. So
that's good though. I mean, that's part of the journey.
Oh yeah, I wrote I didn't actually write a book on this, but it literally filled up like a chapter in my book on all the lessons that I learned. So when I was 22, when I got home, when I got my first paycheck, I Googled, like how do I pay less taxes? And the first couple of different ways were all illegal. Yeah. And then like the first legal one was like a Bigger Pockets post. And I was like, oh, okay. And then I reached out to my older brother who had properties, and I did something that no one should ever do. I reached out and I said, hey, I think I need some tax write-offs. Do you have anything you want to sell? And he literally looked at his portfolio and he gave me the biggest, turd in there. Yeah. So it was a low income property in a bad area that, has always supposed to be gentrifying, but never has gentrified. Yeah. And I purchased it probably without doing a real appraisal. Because I was like, oh, what's your mortgage? I'll just give you that. And it was probably $30,000 overvalued because this was 2011 or something. Yeah, like that. Yeah,
not on full recovery.
Yeah, I probably bought at I overpaid $30K for an asset during. Like I timed it well, but all I needed to do was actually pay the fair value for it. I would have been fine. Yeah. But I overpaid by like $30,000. And to be fair, my brother probably didn't know better anyway. And I ended up property managing it myself because I didn't think I could afford property management. I dealt with tenant turnovers. I dealt with cops. I dealt with the whole 9 yards. And I learned every lesson. And I swore from that day, I was like, you know what? I'm never going to do low income housing. This is too much. And then, 10 years later, I actually have a pretty massive affordable housing portfolio. But
different point of view on how to run it though, right?
Yes. So I do affordable housing at scale, right? Not like one-off Section 8 properties. And it's a very, very different monster. But it's funny because if you would have met me at 24, 25, I was like, oh, I don't want any more of these, blah, 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 blah. 10 years later, different partnership with a real partnership team. And it's a whole different story.
Yeah. Is that what changed in the dynamic of lower income properties or affordable housing, that you had a team in place who could really assist with the management and vetting of the larger scale properties? And more scale, of course, helps.
It's the scale. Yeah. At the end of the day, it's the scale, the fact that you have a mains person on site and you have a manager. And I can really oversee the manager and go high level on things. I'm not the one going out there for police evictions and for police calls and eviction calls, all of that stuff. So it's a very different story. And also what ends up happening is when you deal with affordable housing at scale, you are actually assigned the vouchers for the property. So in addition to some of the tenants having their own vouchers, you would actually have vouchers. And now what ends up happening is that creates leverage between you and the tenants, where the tenants understand that if they are evicted, they actually will lose that voucher support. And that allows you to get really higher quality tenants. So there's very different levels of low income housing. And there's basically, the joke is you never see a Class D property, right? Because everything is Class C. But there's true like Class C minus type of low income housing. And then there's the type that we do. And if you drive into it, it looks like a Class B property.
Yeah.
It's townhouses. They each have parking spots. They have dishwashers in the units. There's a kid's playground over there. And that's what we like to deal with. And we usually have like 100% occupancy last year, I think we averaged 98 to 100% occupancy with a huge waiting list.
That goes to upkeep and management though, because someone could be in the management position to acquire that property, but then just not upkeep it. And then it defeats the whole purpose of what you're trying to do. Because that's what we're missing is affordable housing in America. This is the good kind where the upkeep's there. You're trying to make it, like you said, look like a B, but it just happens to be in a C- area, but you still treat it like something higher.
Well, the area is actually excellent as well. So, you can get that. It's just affordable housing. Usually there's certain compliance issues that scare away a lot of other operators.
Right.
So a lot of the imbalance between supply and demand is that, for example, like if you would say like, hey, how do I find a Texas syndication of a, multifamily? You could just, there's thousands of syndicators in that space. Or
specific for Texas, for sure.
Or Carolinas, but you look at how many operators are dealing with affordable housing, the list shrinks to, 1/100th of that. You have to be pre-approved by the state before acquiring the property.
Yeah.
There's so much that goes into it. And we love it because all that red tape creates a barrier of entry, which you usually don't find in commercial real estate.
Yeah. And then I think the more experience you get in a niche product that you already know how to do, the more opportunity you will have because other people can't do it or they can't catch up to you in what you're doing.
Exactly. And you also, affordable housing is one of the more unique niches because a lot of times the developers who built the property have relationships with the people they want to sell to. I've heard so many stories where, a property would go to a broker and they get best and final, they get a high price for the property. And then the state doesn't approve the buyer.
Right.
The state says this person doesn't have enough affordable housing experience. And it's just a huge waste of time for the developer and the whole nine. So some developers won't ever even list with their broker. They have the list of buyers like us. They'll just go directly to us. If we can figure out a price that works, great. So the true off-market deals, I feel like there's more volume of off-market deals in the affordable housing space than there are in other niches.
Yeah, and that makes sense. And I wanted to go back to one thing you said, because I think you made a great point. Affordable housing is in every city. Affordable housing doesn't operate only C-, D+. Affordable housing operates in the highest end cities in the country. It's just a small subset of where they are. So there could be huge value in it because then people can get into the school system and provide options. And that helps the city with tax credits and everything like that.
Yeah, exactly. And a lot of times, a lot of these the newer builds of the affordable housing come from the LIHTC tax credits. So all of those properties are within the last 30 years kind of built or massively renovated. So a lot of times they are a really good looking property.
Yeah.
You would never, ever be able to tell that it's affordable.
Yeah, I've definitely driven through and someone said, oh, that's public housing. I said, what? Or like, that's the affordable area. I was like, this looks pretty sweet. I mean, if you put these somewhere else, people would say, wondering how much they're going to go for. So it's interesting. Hey, it's Jonathan. This is just a brief interlude to talk to you about Deal Machine. Listen, I've used Deal Machine and I was crushing it with my Concerned Citizen postcard on Deal Machine. You can look that video up on my YouTube and find out how I did it. It works. Deal Machine works. I've had David Lecko, the CEO, on the podcast. So if you want a free trial of Deal Machine, the elite Driving for Dollars app, and I'm telling you, it works if you use it correctly. You can go to my link at bit.ly/Zen Deal Machine. Now, bit.ly is bit.ly/Zen Deal Machine. It's free and you'll be up and running in 2 minutes, and then you can figure out if you want to keep it. Let's get back to the show. In terms of asset classes, though, over your career, what's a asset class other than affordable housing? Maybe if that's number one, what's your favorite asset class as just a class to use to be part of this diversified portfolio?
Definitely, when we started, we went really broad because we were basically we were a limited partner investor on every deal when we first started.
Yeah.
So we went incredibly broad, and then we started kind of filtering in. Right now, we really focus on affordable housing. We have a short-term rental side to our business. Different management group kind of manages that. And then we have a private lending that's kind of incorporated into our income fund. So right now, it's either those are the three asset classes we love the most. We're kind of getting away. We feel like the industry has become a little bit too dependent on some creative cash flow deals that have gone bad. And I label creative cash flow deals where, let's say someone knows how to evaluate a multifamily. Usually they're pretty good at also evaluating a self-storage or mobile home park because the language, the underwriting is very, very similar. There's some nuances like a mobile home park, whether it's public or private utilities. The little nuances, but in general, like you learn the language of commercial real estate. It's great. But what happened, I think, in the last 3-4 years, you saw a lot of like, I know how to evaluate a multifamily, so let me go and invest in oil and gas.
Right.
Because it's also private security. And then there was carbon capture, and then I think ATM kind of falls into that space, and there's a couple of other ones. So we've actually been trying to tell our investors kind of to stay away from them unless you really understand them. If you understand oil and gas, great, go for it.
Right.
But I think we need to be careful to confuse the fact that we've made money in multifamily in 2018 to 2022 when interest rates were very, very low, to the fact that to give you a full sense of confidence in your own investing abilities, where you're going after a lot of these alternative assets that you don't really have a full understanding of. And so that's why we're trying to actually keep it simple. Like we understand short-term rentals. Short-term rentals is basically like a mini hospitality. You're basically running little hotels. We understand affordable housing. We deal with it. We have a compliance team for that, all of that stuff. And then we really love private lending. Like we've replaced a lot of the creative cash flow deals. Like we used to have some ATM exposure. Now we're actually divesting out of the ATMs and just keeping it super clean and going straight to private lending. We find that the returns are very, very similar.
Yeah.
They're easier to understand because ATM investing has a portion of their money coming back as principal. So we think we're right now almost basically, we're 100% alternative investments at Sage Capital, but it's all derivatives of real estate. Yeah. So it's all derivatives of hard assets. So between doing our equity deals, our income fund, and our short-term rentals and our private lending, we think those are things that we can easily explain to anybody. Yeah. We could explain how the collateral works on that, what measures of safety they are for investors. So that's kind of what we recommend, those three asset classes, that those are our core focus right now.
Yeah, I've seen a lot of people that I know getting more and more into private lending as a smart addition to their business cycle, like you said. What's so attractive in that game for you as one of those three pillars that you guys are so focused on now?
So the answer is going to be the partnership team that we have for that division. That's someone we've worked together with for about 6 years now. Actually, no less, a little bit right after COVID. So about 3-4 years now. Yeah. So we have a great relationship with them. They source deals in Ohio. Like I'm in New Jersey, where the average house price is $500,000, $600,000, $700,000.
I'm here with you, and it's fun.
They're out there, and I could build a whole private lending portfolio for $500,000, $600,000.
Right.
So one of the benefits is it's not me sourcing the deals. I'm partnering with someone who's extremely diligent. He's got his own network. He's great at just getting us deals. We're always in first position.
Yeah.
We know we also have the systems in place down there, as we have a portfolio in Ohio. We know that if we need to take that property, we have the ability to take it, send our mains guy there, let him finish it up, and then we could sell it on our end. So we feel really safe being in first position, lending it to the same people, and being in the market that we already are. And then we're getting, our income fund is receiving about 13% in returns from the private lending side of things. The rest is getting split with the person who's sourcing us the loans. So we feel like the returns are comparable, and the risk return profile, I think, is just better than some of these more creative deals that, I just question when I see them.
Yeah, it sounds like, though, what you've built up is really, really strong partnerships in these three areas so that that you can keep, doing rinse and repeat in those areas. And I think that's what people who are brand new starting don't realize, how much partnerships are going to play a role in the future. Like your 22-year-old self who bought that. Were you thinking of it? And when did you really realize that partnerships are the things that are going to help you excel and expand and scale?
Yeah, so we're really big on, relationship investing. We try to coin the term relationship driven investments. I always tell investors, other LP investors, make a spreadsheet, right? And put on one side, put basically like your reputation score, and on one side put relationship score, and list out all your different LP deals and see what is out of 1 to 10, did you invest in LP deal A because you had a 1 to 10 relationship with them, or you had a 1 to 10 based on reputation, or you saw his 20% IRR track record, or whatever it was. And so many investors do this a little project, and then they're shocked where the relationship side is just super, super low. So because we started as LPs, there were deals that we lost money on. And the major commonality of the ones that we lost money on is we had poor relationships with that operator. We were investing purely on reputation and not enough on, I didn't know how many kids the operator had. I didn't know the operator's spending habits. I didn't know, their philosophy on capital preservation. All of these little things, because people hear someone on a podcast and go, wow, this guy is really smart. I would love to invest with him. And then they call the guy for a 30-minute intro call and, oh, okay, this is great. I'm ready to wire. And people don't really understand that, we actually are pushing our investors. Don't invest with us until you know us for a year or two.
Yeah.
It's fine. We don't want investors rushing in to these deals because we're long-term buy and hold. So if we're holding on for 10 years, we don't want you to be upset after year 2 or 3 that, 2 of your other deals went full circle and if we're not refining, we're keeping. So it's kind of, we want to make sure that relationship is there. So part of it is learning from our mistakes, and the LP mistakes were poor relationships. And then second of all, it was just there was a core group of people around me that we spent a lot of time. I always recommend to investors, when you're starting out, build a network of 5 other investors that you could get on a call with once a quarter. That's all you need. That's 4 calls a year. And I did that with 20 investors. And out of those 20, 5 of them became my partners. And some of them, and I'll tell you a quick funny story.
Yeah.
My main partner, Anthony Kahn, who's the other managing member of SIH Capital Group, we went on a trip together. We were kind of blind dated together because during COVID, an operator that we both invested in was doing an open house at one of his newly acquired properties. And I think he was still raising on the property. So he basically let all his LP investors know, hey, we're going to do this open house. There's no flights at that point, and it was 8 hours away. So I messaged him, and I didn't have a great network at that point. And I messaged him. I was like, hey, I'm really interested in going. Do you have anybody else in the same geographic area? He said, yeah, I actually have someone I think you'd get along really well. He introduced me to Anthony. The funny part is my wife, it tells me this, we joke about this. She's like, you're going to get into a car during COVID with someone you've never met, and you're going to drive with them 8 hours. I said, technically 16 because you got to go back.
Right. We have to get back somehow.
And then I told her, I was like, don't worry, he's a real estate investor. And, we'll find something to talk about. Sure enough, Anthony gets in the car, and it was 8 hours straight of us just talking. Turns out Anthony was in a lot of the other alternative investments that I was in. He was doing a lot of the same stuff. And Anthony turned out to have specialized in affordable housing and had a relationship with this big developer in Pennsylvania.
Yeah.
And it was those 16 hours of bonding. And then on top of that, I'm dropping him off in Philadelphia after a very, very long trip. And I tell Anthony, I'm like, hey, do you want to set up this quarterly call? Anthony misunderstands me, and by the time I get home, I get a calendar invite for a weekly call. And, and I said to myself, I was like, wow, I was like, if this guy's willing to put that kind of energy into the relationship, like, why wouldn't I match it? So I accepted right away, even though, I really
you were like that was a lot. Yeah.
I thought that was a lot. And then we spent 2 months basically on a weekly basis, just me learning about affordable housing. And then it was the origin of SIH Capital Group, basically.
Yeah.
All of those conversations, those weekly conversations. And Anthony was a guy who was a project manager at the time. And we were getting on the call at like 9:30 p.m. And it was 9:30 to like 11:30 every single night. Not every single night, once a week.
Once a week, yeah.
And 6 months later, our Oxford Village came along, and it was just, we were already partners at that point. It was crazy. It was just the relationship kind of naturally thing. So when people ask like, well, how did you get into affordable housing? The truth is because I got into a weekly call with someone who specialized in affordable housing, and I made that commitment to him. He made the commitment to me. And then, we spawned from that.
Yeah, that's amazing. And I think it's a great note for new investors. Your start is get to meetups. Obviously, this was during COVID. The meetups weren't happening. But if you hadn't have accepted or taken that leap to go look at a property that you were both kind of invested in or interested in, the company may never have happened.
Yeah. And, yesterday I was invited to a meetup, and I was kind of hesitant on going there because the topic was very new oriented.
Yeah.
And then I went there, and so many of the people in there were brand new. And there's nothing wrong with that.
Yeah.
But they were just asking the wrong question. Everybody was asking, well, how do I find a deal? And where would I get this deal, whatever it is? And, the speaker answered the question, and I get the thing. But I would have answered it completely different. It's how do you find your first deal? How do you look for your first deal? Is you learn to build relationships.
Yeah.
That is everything in our space. You build relationships with 5 people in that room before you leave that room. You're going to be fine. In a year or two, you will have those deals.
For sure.
It's like people are like, well, how are you in mobile home park self-storage? Because I have relationships with someone who only does mobile home park and self-storages. And when they're looking for diversification, they're actually coming to me. So they're investing into my projects, and I'm investing into their projects. And we have this, small circle, and everybody's investing with each other because everybody knows each other. Everybody understands the philosophies. We get on calls together, all of that stuff. So I think people are too focused, especially when they're starting out, on how to find a new deal. They're like looking for Detroit for $1,000 thing, whatever. I'm like, what are you doing?
Yeah.
Like you find the deal by finding the relationship first, and then the deals will come.
Yeah, I think it goes to a long-term, short-term philosophy. People are like, oh, I want to get in the game. I want to get in the game because like social media is saying, hey, get in the game. But really getting in the game is, like you said, going to meetups, meeting people, nurturing those relationships, figuring out what you even like. I mean, if you haven't talked to people for that long, you don't even really know like that you're going to suck as a landlord, because most of us do. It's terrible. Nobody likes it. You have to hire. That's why we all hire out. It's not a fun thing. But yeah, I think that if people were to stop and instead of like, looking on the internet and going to a spreadsheet and doing deals on some place they've never been to, and they're like, oh, I've looked at 20 properties this week on a computer, and just spent all that time going to meetups or in Facebook groups trying to turn it into real life, you're exactly right. You'll whittle down the group of people to the ones that aren't really in it for the same reason. Find a group of just a couple. For you, it started out as just one. Get on a call, and the next thing you know, you add a third person to the call, and then the fourth person, like, wait, I know these people. It's really, really great advice. I hope people can really pick up on that you'd be much better served, I think, especially now with the prices of everything and the interest rates. Spend the next year just making as many relationships and learning. And like you said, have better asks. Always asking, well, how do I become rich? Or, how can I get a 10-plex apartment when you don't have any money? It's not the right question. That was a really good point as well.
Yeah, look, I heard yesterday, the questions I heard was like, can you buy with no money down? Can I get, it's all questions that I'm like, you're going to be asking these questions in 9 months to a different speaker because you're looking for a magical answer. Like, it's not a fairy tale. A lot of this is work and commitments. And a lot of people like come back to me sometimes and be like, well, I made 5 connections. I'm like, okay, did you follow up with them?
When's your call?
When did you call? Did you set up? So like one thing I said is like, well, did you end the email saying reach out when you have a chance, or did you end the email saying, hey, does April 17th work for you
Right.
at noon? Because I would love to jump on, a 30-minute call. Because in one situation, you're being lazy and you're not going to get any results. And
Yeah.
the second situation is you're taking an actionable step. And that's what you need to do. You always need to take these actionable steps. Like, that's why at this point, like when I get those LinkedIn requests and they're like, oh, just let me know how I could help. I love following along your story. Or when I get the messages from other operators saying, we think you might want to invest in your deal. I'm like, well, you didn't even look at my profile, figuring out that I'm not even an LP anymore. So it's like, why am I wasting my time to respond to you? So all of those little things, I think, make a big, big difference.
Yeah, I agree. From being on the receiving end, I'm much more likely to respond to somebody who's done the research, knows what I'm about. It's like, even for this podcast, I can look at my inbox every day and it's like, there's either a pitch or the pitch is to me. And if the pitch is to me, I'm like, oh, okay. Even if it's like a little bit AI driven, but as long as it's talking about my podcast, if it just says like, hey, I want to, I have a guest for your podcast, and then there's nothing about my name or anything. Like, I know they're sending the same thing. And like you're saying, though, that's what people are doing in person. They're going around to each person. How'd you get successful? It's like, well, and they're not even taking value, because I think as a person asking that, you're not bringing anything to the table. Everybody has some skill set. It could just be hustle. It could be time. It could be anything. It could be a background in accounting, plumbing, anything. You have an asset to bring to the table in real estate. You have to use that so there's some type of win-win. And it's not just one party saying like, I'm going to help you, and you just sit there. It's no fun.
Yeah. I think one of the best pieces of advice I think I ever got, I forgot if it was like from Brendan Turner early on in one of the podcasts, was like, never give the person you're asking for a job. Like, you never give them the job of saying like, how can I help you? Because it's just the most like asinine question ever.
Yeah.
It's like, know your skill set. And at the same time, like, I would even rewind before going to a meetup, learn some key terms.
Yeah.
You don't go to a meetup and say, well, what does that mean? Like, what does that mean? Like, what is an IRR? What is a cap rate? I always say, like, great shortcut in learning terms and stuff like that. Go on LinkedIn and just put in an investor. You're going to get bombarded by those pitch calls.
Yeah.
And the one good thing about those pitch calls is that it will sharpen your language and the lexicon of commercial real estate. Like, don't waste any time on them. But after taking the call, hey, 3 terms came up that I didn't know about. Cap rate, the IRR, and I don't know, cash on cash. Right. And now go in and Google and research them, and that's it. And then do a couple of those calls and now go to a meetup, because at least you have some kind of knowledge. Like if you're going brand new, you don't have any knowledge, and all you're going there is just to waste people's times and ask them like 100 million questions because you did no work. Like, what does that say about you as a partner?
Short term. You want the rewards, like you said, you want the magic thing. I think it's really important. Imagine the difference in the scenario that you're talking about somebody coming up to you and saying, what is cap rate? Or they say, I've done a lot of research on cap rate. What's the cap rate that you're looking for on an industrial project? That's a great question, and very easy for you to answer and not think, well, this is a waste of time. That's a very good use of time.
Exactly. I think and also knowing that the person who's speaking is in the industrial space, right?
Right.
Something like that is just super, super simple, and it just shows some effort. And it's like, people are just shocked when they don't put in any effort and get no results. They're just stunned. And it's like, why? That is what is supposed to happen. If you put no effort in, nothing is going to happen. Yeah.
I feel like I'm the Grim Reaper of Bigger Pockets Forum sometimes, because someone will put like a question like, how do I become an investor? And then I just like, I don't know, maybe I destroy their confidence, but it's the truth. It's like, I don't know enough to even help you. I don't know how much money you have. I don't know where you live. I don't know what your motivation is. I don't know what your real job is. Like, what's the why behind you asking about investor? And then when you ask them that, they're like, oh, I want money. And it's like, no. It's deeper than that. You're not going to get far unless you dig a little bit deeper. And I think you're really helping people now just in the relationship aspect, because this is about the mindful approach to real estate investing, and the way that you're running your business and building and scaling your businesses is all relationship based. The assets are secondary to the relationships you build. And I think it's even more important, like you said, in syndications. I personally I invested in my first syndication at 53 years old, or 52 last year. And it was all on the operator. I did my due diligence on the operator. He was somebody that I was talked to. I kept following up, and he was always available. He wasn't shy of saying, like, not all deals aren't a home run. This is the track record. And I knew going into it, the asset looked good. The paperwork and everything looked good to me, but I knew I was going to be fine when I dunked it in there.
Yeah. And I think too many times, and like now that you kind of bridged the topic of LP investments and things, I think too many times LP investors treat the operator like they're a pseudo celebrity.
Yeah, exactly.
Just because they've been on a Bigger Pockets podcast or something like that. And the truth is, I've learned so much from my LP investors. I had one lady, she's also in New Jersey. She asked me for my personal financial statement. And like, at first I was like, that's weird. I never asked that.
Yeah.
I did 20 LP deals in my life and I never asked that. And then I thought about it, and I said, it's reasonable. I get it. She's willing to put in money in one of my deals, and she's asking if I have the capital capabilities of, if things get tough,
exactly,
to keep the deal afloat. I sent it to her within an hour, and she appreciated it. And then she had a couple of questions. I had a couple of follow-ups. They were great. And that was way better than an LP investor just saying like, hey, I heard you on a podcast. You sound great. I want to wire you money. Those are the ones we actually need more.
I agree.
We need something in between here.
I feel like those are going to be the ones who complain, though, because they're not doing any due diligence. So then the second that you take the money, like all of a sudden now, oh, wait, I thought you were going to be a silent LP. Like, that's why you're an LP. I don't want to hear all of your stuff right now. Like, this is how it is. That's a very, very good point. And I think it's a great example because she asked the right questions. Right now, we're in the middle of 1 million extra capital calls on syndication. Yep. So it's helpful to know that the people that you're, doing the deal with can cover overages or at least have a plan in place. And that's where, not to say brand new syndicators can work if they've really come up in it, they've learned from others. But I'm more weary of brand new syndicators now just because of this scenario. Rates are high. I don't know what's going to happen. What's the backup plan? So that's a really good point and a good question by her.
Jonathan, you make a great point, but like I would also be careful with brand new. Like I think we need to define like what time period that is technically, because SIH Capital Group is a brand new syndication because we were born during COVID.
Yeah,
but we only do long-term buy and holds. We really only do fixed rate debts. So we take some of the newer syndicator risks. Now, if you got it, I would also argue that hey, if you started in 2018, 2 years before us, you might have a couple of exits under your belt with really high IRRs.
Yeah.
I would still classify them as new syndicators because they entered in a decreasing interest rate environment. They got out of the deal, to be fair, they got out of the deal by keeping it afloat and someone else paying a higher price because the interest rates went down on them.
Yeah.
And then now they're in 2022 and 2023. And I see this all the time and it drives me absolutely nuts. And they're out there, and I've seen these at conferences, and they're like, look at our track record. We have, 6 exited deals at 22% IRR. Yeah. I'm like, you started in 18. You're leaving in 2022. Of course. Who lost money on a deal between 18 and 2022?
Yeah, I hope nobody, but they did, but not many.
So be careful. So my advice to LP investors is be very, very careful of not leaning too much into a track record. Yeah. Make sure you understand what time period that track record covers. Make sure you understand what kind of loans are they getting on their deals today. Because if they built up a track record in 2018 using low-cost fixed debt that's assumable, great strategy. But then if they pivoted to variable loans in 2020, 2021, when those deals because it was harder to pencil out a deal. Yeah, so they went more aggressive on their financing. That track record no longer holds the same amount of weight than you got someone who's been in this game for 20, 30 years or someone who's newer but doesn't tout their track record but only does long-term buy and holds. So everything, you have to take things with a grain of salt because this syndication world is really, there's two people in there. There's a marketer who's really great at
Exactly.
attracting investors. And then there's an operator. Sometimes they are the same person. And sometimes you are investing strictly with a marketer and you have no idea on their operational capabilities. And it is way more important to understand the operational capabilities, in terms of, hey, do you do self-management? Is it internal or is it a third party? Well, what is your history with the third party? How many capital calls have you done? Like all of those questions, people don't like to ask because they feel uncomfortable asking tough questions. It's almost like if you're a married couple, like, you don't want to ever ask a question like, hey, are you cheating on me? But unfortunately, it's like you have to ask those questions sometimes. And you ask those questions before you wire the money.
It goes back to what you said, though, that they kind of have this celebrity aura about them because you've seen them. So you're like not upsetting the apple cart, but you really need to because you want to be tight on your deal. And like you were saying, I think transparency is a big thing. If you can't get the answers for the things that you want, that's your answer.
I as an LP one time, I remember there was an operator that I got on the phone with, and I had a great introductory call with him. He sent me over a deal. The underwriting looked fine, but I spent an hour drafting him an email of questions, an hour of my life, and I got no response. None. It was very, very clear. Now, maybe it went to spam. I didn't really follow up on it. Could be. Not
everyone should check their spam.
Maybe it went to spam, so I'll give the guy the benefit of the doubt. But the point was that he wasn't willing to respond to, I wouldn't say, and then sometimes I reread those questions once in a while just so I could put my investor hat on. And I'm going to say like, hey, were they outrageous questions? Whatever. They were fair questions. If an investor would have asked me those questions, I would have took my time to answer them. And just those are the little things that investors don't understand that can save them so much time and effort. It's just actually ask some questions, put in some effort, look through the OM. The operator should actually appreciate that.
Yeah, I was about to say that. I think a good operator is going to learn from those questions and be like, wow, okay, we're missing this, in our PDF or our slide deck. This is something that's missing. Now we need to add it. Great questions. You want those questions because that helps you perfect what you're doing. I think that's really important. I think that you did make a really good point, again, about marketers versus operators as well, because I think the, social media potential is out there for people to just be really shiny, send something. It looks great. Property looks great. So you're really into this kind of opportunity that maybe or maybe not exists, and that fuels what half of social media is. So to be able to take a step back, send a list of questions and get an answer really will tell you a lot of what you need to know about the deal.
Yeah, and then it ties in perfectly to the relationships stuff. Like if someone is very shiny on social media, try to establish a relationship with them. Yeah. Most of the time they will have an investor relations person, and there's nothing wrong with that position. But I personally, I will never give up investor relations for SIH Capital Group. The day I do that, we're going to stop acquiring, we're done. Because that is the part that I love the most. It's to get to know my investors and know who I'm fighting. When I'm putting out fires, I know who I'm fighting it for. Right. And I don't want to ever do that. So when you see these marketers out there, and there's some really big names out there, right? Go try to create a relationship with them. Try to get on a quarterly call with them. See what happens. Before you invest, see what happens when you actually try to create a relationship with them.
I've seen this happen time and time again where I'll say, hey, I'm really interested. I'll follow up, and I'm talking one-to-one like this. And then I follow up and I'm in a funnel. And I'm like, I literally just talked to you for an hour. Why am I going into the funnel? I'm above the funnel, and I've been investing my whole life. So why would I go into the same funnel as baby investors? This doesn't make any sense. And I think that's a really good point. I think, you just have to take what you want from it. I want the one-on-one relationship. You want the one-on-one relationship. If someone's not willing to give it to us, it's not a good fit for, what we want to do together or in a portfolio. You know what you're expecting as an LP, but you still want to at least have someone on the upfront. If you're going to pitch me, that's who I expect to talk to, not a VA.
Exactly. And that and investor relations people, they're great, but the culture always comes up from the founder. The founder is supposed to be setting the culture for the property. And one of the investments that I ended up investing in that turned out to be a Ponzi scheme, I thought I had a great relationship with the investor relations person. But one of the big things was, hey, I never ever talked to the CEO of the company.
Yeah, they could be totally disconnected from the CEO. Yeah,
exactly. And if I don't know what the culture is like on a deal, we're not going to invest in that deal. It's that simple. It's like little things like that. People don't understand how big of a difference they have to their overall returns. Because again, people like to invest on reputations. People like to say, oh, I'm invested with such and such name.
Yeah.
Like, what does that mean? It means nothing.
Yeah, I feel like people, like, I love the book Who Not How, but I feel like people have taken it too far. They've removed themselves. Like, they want to be the face out there, but then most people want to talk to the face. So it's like you're going to devalue your overall long term. You're going to get a bunch of new people in. And like we were saying, that is not your best money. New people are going to ask more questions, require more hand-holding, and they're not your ideal investor. And it means you're trying to fill up your cup the wrong way, in my opinion.
John, I couldn't agree more. And one of my hero companies, I'm not going to mention their name, but they shut off their investor list. They got to the point and they're like, we're done. And I can't wait to that day because I find social media very it's a necessity these days, but I can't wait till, I like getting on podcasts here and there, but I also hate going on social media after that and everything. I can't wait till the day where I get to the point where I'm like, okay, SIH has enough investors to feed their next 5 years of investments. And then I could just shut off the list and actually refocus on getting on my calls with my investors.
Yeah, exactly.
Like fostering relationship, because there's this, in the last 5 years, there's this school out there, right, of thought. And I'm not going to mention any names, but they all come from this same capital raising philosophy that you should be pitching to the millions and stuff. And to me, I hate it. It's absolutely the worst thing ever. Because I've had investors who've invested in every single one of my projects.
Yeah, exactly.
I would never get that if all I'm focusing is talking to the millions. I want to talk to the people who I know value what I have to say, because I underwrite at 13 to 15% returns, because that's how the people I learned from always told me to do it. So I don't want to be competing for the attention of someone whose buy box is only a 20% return.
Right.
I won't be a good fit. Yes, some of my deals will hit that. That's great. But I also want to be very selective, because if someone's coming in with the wrong expectations, I could do a great job on my end and still get bad reviews. And the word of mouth in this business is crazy. So it is really important to respect your reputation and all of that stuff. That goes hand in hand.
Yeah, I mean, nothing's better than a wait list, because it means you've reached the capacity and you're comfortable. And like you said, then you can refocus on just the people who are already actively investing with you. And hey, look, when they get off the wait list and they get an opportunity to come in, then they'll get the personal care. But right now we're full. And then, of course, everybody wants what they can't have. So it becomes even more popular. I think that's a really good point. Awesome. Denis, where's the best place to get in touch with you? I know the website is sihcapitalgroup.com, but where's the best place for people to reach you if they want to talk about deals that you guys are doing?
Sure. So SIH Capital Group probably is the best place. My first name, Denis, D-E-N-I-S, it's one N at SIH Capital Group. Capital is with an A, group.com. You could message me on LinkedIn. We also did write a book on alternative investments, the Alternative Investment Almanac, expert insights on building personal wealth in non-traditional ways. You could find that on Amazon, where we introduced an asset class, and then we had a Q&A with 2 different investors from that asset class. The really cool thing about that is that you would get the perspective of a mobile home park investor, operator, and then you would get the exact same questions for a self-storage operator. And some of the questions are well, how do you see the asset class in 5 years? So it's actually really, really relevant. I think that book is excellent. So between the book, between LinkedIn, between SIH Capital Group,
they'll find it.
And I am always when I tell my investors, hey, I'm willing to jump on a quarterly call, I literally mean it. And the day I can't jump on those quarterly calls anymore, SIH Capital Group is probably going to start phasing out, because then I'm doing it wrong.
Yeah. Well, I really appreciate your time. Your philosophy and the way that you do business is a perfect match for the mindful approach to real estate investing. So I'm glad we got in the time together. I really appreciate it.
Jonathan, thank you so much for having me. I had a blast.
Yeah. All right. That was Denis Shapiro, with the managing partner of SIH Capital Group. I'm Jonathan Green. We'll see you next episode. Wait, you have reached the end of the show. This is the part where you're going to get ready to check out, but I've actually changed this part. For over 120 episodes, you heard the same thing. Well, now I've changed it. I've thought about doing intros to the next episode, but I'm going to hold off on that for now. These are my pitches at the end. I've got nothing to sell you at all, but I do want to remind you that it really would help us if you support the podcast in the right way. All that means is subscribing to the podcast so you get it on Monday and Thursday, writing us a 5-star review if you believe that we deserve a 5-star review, sharing it with your friends, and being a participant in the Zen and the Art of Real Estate Investing community. Soon there's going to be a new website launched. Maybe when you're listening to this, it's already going to be out there. That's where we're going to have collaboration. You're going to be able to see a lot from the guest. It is coming soon, and I just want to tell you, from me to you, I don't know how I got here, over 100 episodes. I'm so appreciative of you listening to the podcast and especially sticking around to hear this part. We'll see you next episode.